University of Sydney, you may begin.
We present a buy recommendation with a 12-month target price of $15.95, representing a 14% upside. Following their successful acquisition of Sydney's largest ever toll road, Transurban has cemented its dominant market position within Australia. The group operates 21 toll roads across Australia and North America, with 93% of FY21 revenue generated in Australia. Transurban's key competitive advantage is their interconnected urban toll networks. Every single Transurban road is connected to at least one other Transurban road, which uniquely positions them to benefit from traffic synergies, unlike single road operators. Despite stringent Australian lockdowns in late 2021, traffic volumes are now matching or even exceeding pre-COVID levels on many of Transurban's roads. We also anticipate severe weather and COVID-19 will continue to cause public transport usage to remain muted in the medium term, whilst vehicle registrations continues to rise sharply as people shift towards preferring private transport. However, recent equity market volatility has resulted in a mispricing. Transurban has always traded at a premium multiple, but it is currently trading over one standard deviation lower than its average historical EV/EBITDA premium to listed infrastructure peers. We issue a buy recommendation driven by 1. Traffic volumes being boosted beyond market expectations by trucks and returning airport traffic. 2. Transurban's underappreciated market power, making them the natural heir to future toll road concessions. And 3. Transurban's inflation-hedged cash flows will provide investors with stability in a volatile market environment.
Transurban's traditionally stable traffic volumes have been hampered by domestic and international travel restrictions. However, as lockdowns in Australia are now in the rearview mirror, we expect rising truck and passenger vehicle volumes to exceed market expectations, driving a strong recovery in cash flows. Large vehicles, which account for 35% of Transurban's revenue, typically transport freight and building materials. However, a lack of rail infrastructure spending across Sydney, Melbourne, and Brisbane will continue to increase our reliance on trucks to transport freight. We expect this trend to be accelerated since COVID-19 has pushed forward the demand for e-commerce and rapid freight solutions, whilst rail projects have lagged behind. For building materials, Transurban's roads are positioned close to ports, terminals, as well as major construction projects. Therefore, we expect strong truck traffic to be driven by a rise in both freight and building materials transportation. Specifically, large vehicles are tolled at a 2 to 3 times multiple, and we forecast large vehicle traffic to grow at a 6% CAGR through to FY25. This will result in proportional EBITDA margins expanding to 78% in FY25. However, market consensus of 75% implies only a 2.3% CAGR in truck traffic growth, which is in fact below pre-pandemic averages and is evidence of market underestimation. With regards to passenger vehicles, we view the return of domestic and international travel after lengthy lockdowns and border closures to be strong drivers of traffic recovery. 53% of Transurban's roadside revenue are direct connections to airports, with its networks forming key gateways in and out of capital cities. Record camper van and boat sales in Australia over the past year will also drive demand for road trips, and the lifting of travel restrictions around the world will support traffic around airports. As such, we expect traffic on key roads such as the Melbourne City Link to grow 51% by FY24.
We view Transurban as the natural heir to future Australian toll roads due to their quasi-monopoly position, with the market underestimating traffic synergies derived from such market power. Having acquired 17 of the past 18 Australian urban toll road concessions, we expect Transurban to experience similar success securing future extensions to their networks. Over its lifetime, Transurban has gained extensive expertise in operating toll roads and unparalleled understanding of traffic and cost advantages lowering their operating costs. This, coupled with Transurban's strong senior interest coverage ratio above 1.5 times free cash flow, positions the group to capitalize upon future opportunities. National budget deficits further incentivize privatization to provide governments with immediate cash. And even if Transurban does not acquire these new roads, new connections to its vast network expands Transurban's catchment area, offering traffic synergies in two ways. 1. New roads will divert users from alternative routes, and 2. New roads create routes to new regions. Both synergies affect connecting assets by adding a forecasted 1.5% of traffic above market expectations. Thus, simply forecasting organic traffic growth is misrepresentative of Transurban's size and its network.
Recent geopolitical and macroeconomic events have exacerbated equity market uncertainty, but Transurban's stable and inflation-proof cash flows makes it an ideal hedge against systematic volatility. Geopolitical tension in Europe, supply-driven inflation, and uncertainty in monetary policy have driven the S&P 500 volatility index to a 52-week high. In this volatile market, Australian infrastructure is attractive for its low systematic risk, evidenced by its low beta. Transurban has an even lower beta, yet maintains the highest gross annual return across the same 5-year period, presenting highly attractive risk-adjusted returns driven by the stability of its traffic volumes. Ongoing supply chain disruptions will lead to sustained inflationary pressures, but with 88% of its assets either pegged to CPI or set well above target inflation, Transurban will remain largely unaffected. The few remaining listed Australian infrastructure peers all face higher operational uncertainty, whereas highly inelastic toll roads are unlikely to see traffic volumes affected by macro and global events. Hence, we believe resilient cash flows in this period of uncertainty will lead to strong traffic numbers in FY22, catalysing a re-rate in Transurban's multiples back to its usual premium. Despite inherent operational challenges, Transurban has established itself as an industry pioneer through its ambitious ESG initiatives. Recent wind energy power purchase agreements will generate 80% of energy for New South Wales and Queensland operations, reducing emissions by a third in the next 2 years. Transurban has refitted its tunnels with energy-efficient LED lights and ventilation, repurposed old truck tyres into asphalt, and placed emphasis on reducing uphill gradients, which is where vehicles, especially trucks, pollute the most. These initiatives support Transurban's emissions goals, including net zero by 2050. Transurban is also making strides within the community, distributing 10 million in toll credits during COVID to alleviate the financial burdens of families, whilst installing 27 kilometres of noise-reducing walls. Despite operating in a male-dominated industry, Transurban's commitment to diversity is seen with a majority female executive committee, far exceeding ASX 200 averages. Management governance is also very strong, having achieved an injury rate significantly lower than construction peers. As a result, Transurban has attained ESG scores, which leads comparable infra peers across 3 different financial data platforms.
Our valuation consists of an equity sum of the parts DCF weighted at 50%, dividend discount model weighted at 20%, and a relative valuation weighted at 30%, arriving at a target price of $15.95, which represents a 14% upside on last close. Our intrinsic valuation was derived by individually forecasting free cash flows to equity for each of Transurban's roads until concession expiry. Traffic growth was projected based on trucking and construction activity, traffic synergies, demographic trends, and historical characteristics of each road. To capture Transurban's unique operating characteristics, our relative valuation weighs 4 comparable sets: toll road pure players, European operators, Australian infrastructure, and global infrastructure. Transurban has historically traded at a 151% premium due to their superior market power and toll escalations. We expect this to continue, driven by Transurban's sustainable competitive advantage. Hence, instead of adopting a typical median trading multiples approach, our relative valuation compares Transurban's current EV to forward EBITDA premiums to its historical average premiums.
We recognise that there are 2 key downside risks to our recommendation. Firstly, there may be high oil prices, and secondly, regulation may block future acquisitions. However, after running a number of scenario analyses, we've decided that these are insignificant and do not change our target price. In conclusion, with rebounding traffic, Transurban's dominant market position, and its stable, inflation-proof cash flows, it's clear the light at the end of the tunnel is closer than ever. We are from the University of Sydney, representing the Asia Pacific. Thank you for listening. We now open the floor to questions.
I can start. Your thesis is built that the use of trains and buses will remain muted and people will transition to personal vehicles. I would like to discuss the regulation risk here. Do you see anything impacting this?
We don't recognize that there's much of a risk here. There's only some tolling reforms around the place, but we think that public transport will remain muted because of coronavirus concerns as well as flooding concerns. So we don't think there's a big risk to our recommendation here.
And to add
And
to
just
this,
adding
if
on
we
to
flip
that,
the slide.
you go.
So to add to this, if we flick to this slide, we can see that the bottom graph there, that public road transport use has recovered compared to pre-pandemic. Whilst if we look at traffic volumes, if we look at public transport modes represented by the light green line, this has not recovered to pre-pandemic averages, and this is due to a number of reasons, including extreme weather events here in Sydney, as well as a general preference towards public transport due to continued fear of COVID. And at this point, no governments have introduced any regulations that will materially affect Transurban's traffic volumes, in our opinion.
Okay, and how does this connect to another pillar of the COVID reopening? So on one side, you're saying that this will remain muted due to COVID, but on the other side, you're betting on the reopening.
So we think that generally traffic is going to be going up when it comes to private transport. If we look at the traffic volumes on the same graph here, we can see that they are already on the very right-hand side close to pre-COVID levels. Whereas with regards to public transport, because there is that public element where people are potentially exposed to COVID, and where there's still quite a number of cases in most states across Australia, we think that whilst the government has reduced regulations and there are no longer any restrictions on travel, people will still prefer private transport because they feel mentally safer within their own cars rather than riding on public transport where they are exposed to other people.
And just adding on to that, if we go back to that slide, Richard, and if we look at the top chart, it illustrates the recovery of traffic on airport-linked roads, and we have seen a significant uplift, especially in the last few months, as we see that borders open up both within states in Australia as well as to overseas countries. We've seen a pickup in airport activity and associated traffic on the airport-linked roads.
Thank you. I'll take another question. Could you please elaborate on your analysis on oil price increase driving ahead inflation risk, please?
Yes, I'm happy to take that one. Richard, can we please go to slide 130? So whilst oil inflation remains a concern in people's in investors' heads, we think that because toll prices and oil prices don't actually constitute a majority of a household budget, and there's fiscal relief as well as OPEC relieving oil supply, we think that these contribute to oil prices decreasing in the near future. And even then, it requires a very high sustained oil price in order to have our recommendation flip from a buy to a hold. So we think that this is not a risk that poses a major threat to our recommendation.
Well, following on that question, the company recently said that in the near term, inflation was good for the company, and you present us one of the highlights that they have inflation hedge cash flow. So why do you think that the company is saying that in the near term, if inflation is good for the company?
Thank you for your question. I'm happy to take this one. If we flick to slide 135, so the majority, that is 88% of Transurban's roads, are hedged to inflation. So basically what that means is the higher CPI is, the higher they can charge for their tolls. And this is through an agreement with each of the state governments that they operate with. As a result, it means that if inflation is higher, their revenue margins their overall margins actually expand because revenues will increase, but costs through their fixed contracts that they already have don't increase at the same rate. if we look at the sources of inflation in Australia, whether that's energy prices, supply chain disruptions, or labor market conditions, as you see on the left-hand side of the slide, we think that as a core infrastructure facilitating mobility, Transurban's actually going to be a beneficiary of the productivity improvement and continued public transport aversion. If we look at our sensitivities on the bottom right-hand side of the slide here, we can see that even when we sensitize inflation well above what the target rate is from the Reserve Bank, our share price is very minimally affected because of the hedging characteristics of Transurban's roads and how they allow for higher margins and do not actually disturb our recommendation.
And just adding on to that, we've historically observed quite a low elasticity of demand with regard to traffic on Transurban's toll roads. So we see that even if price goes up on Transurban's roads in line with inflation, we don't expect that to dramatically influence traffic.
Can you comment a bit on their leverage position, how they're managing their leverage? Do you think they're over leveraged, under leveraged? How is the position right now?
Yeah, I'm happy to take this. Richard, if we could please go to slide 90. Thank you. So despite COVID-19, Transurban demonstrated the ability to continue accessing debt capital markets while maintaining strong SACP ratings across all their underlying assets, which is unheard of for a global toll road operator with all their underlying assets being BBB plus rated. This is partly due to sort of their very prudent cost management, but also because during that COVID-19 period, they leveraged their strong Swiss bank relationships to issue a CHF loan at a coupon rate of around 0.875%, which was in a climate where the European investment grade credit spreads was 81 bips, 46 bips lower than comparable US investment grade credit spreads. And so as a result, if we go to the next slide, please, Richard. We can see that Transurban, not only with the actual asset credit ratings and the debt they've drawn down, but their debt book is quite robustly hedged against rising interest rates. And so they're well positioned in terms of their capital management their debt book is well positioned to last through the next few years as their new assets come online and form the ability to capital release as well.
What's their coverage ratio at the moment?
That.
The question is for
Sorry, could you just repeat your question at the very end?
What's their coverage ratio?
Okay, so if we turn to the slide 13, on slide 12, we can see at the very bottom left, their interest coverage ratio is rising, we think, due to rebounding traffic. Right now, it's at approximately 2.8, and we see this actually increasing as traffic returns because this will increase their revenues post-COVID and obviously increase their ability to cover their interest payments.
And if we can flick to slide 93, Richard. So Transurban raises its debt on an asset-by-asset basis, and we can see that in FY21, some of their roads did experience a decline in their debt service coverage ratio due to a lack of traffic, especially in North America. However, given their strong bank relationships, they have been able to refinance their debt and to essentially allow for less covenant restrictions on their debt. And as we expect traffic to recover and the cash flows to recover, we expect their debt coverage ratio to improve over time.
Okay.
For your DCF model, how much value is driven by each of the 4 factors that you incorporated in the model?
Right, and sorry, just to clarify there, when you say the 4 factors,
you said there were 4
mean...
factors on the slide that you've modeled
right,
separately?
Right. Yep, correct. So those geographic characteristics that we do touch upon when considering each road's, I guess, proximity to ports, terminals, linkage to airports, surrounding land developments, and the network effect of connecting roads. But if we actually look at slide 117, we see how it's different depending on the region that each road is in. So if we look at the traffic assumptions for New South Wales, or for Sydney really, the period covers airport traffic recovery, freight rail development, the Parramatta CBD construction, and the FY26 opening of the Western Sydney Airport. So those were the factors that were considered there. And because Transurban's network in Sydney is quite large, it's very much the network effect as new roads come online that's driving growth. If we turn to the next slide, across Melbourne, Brisbane, and the North American roads, it's new roads coming online that really drive growth. With Melbourne, it's the Westgate Tunnel and CBD traffic recovery. For Brisbane, it's the forecasted uplift that comes from the Brisbane Olympics. And for North America, it's the lane expansions across their GWA express lanes. And beyond that, all roads are kept at a terminal growth rate of 1.5%.
And your valuation, you blended multiple valuation methods. Can you talk a little bit about how you did that and how you came to those weightings?
Sure.
Yeah,
Richard, if
yeah.
we can go to slide 120, please. So what we did was we chose 4 comparable sets to capture Transurban's unique characteristic as a pure play toll road player operating in Australia and as one of the largest global infrastructure firms in the world. So we constructed 4 peer sets, which is on slide 122. However, just staying on this slide, so what we did was we generated the historical daily EV to forward EBITDA multiples for Transurban, as well as each of the comparable sets. And then we compare the premium of Transurban's multiple on those comparable sets over the 5-year period. However, we see that currently Transurban is trading below one standard deviation for most of compared to its historical premium for most of the comparable sets. So we assume that Transurban will continue to trade at this historical premium because of its sustaining competitive advantage. So what we did was we applied the historical average premium to the comparable set's current EV/EBITDA multiple to arrive at what we think is a fair EV/EBITDA multiple for Transurban, and that's how we arrived at our relative valuation price.
And those 4 comparable sets were all equally weighted at 25% each.
Time. Thank you.